The four main financial statements are the balance sheet, the income statement, the cash flow statement, and the statement of shareholders' equity. The hotshot courses on the individual statements provide a lot more detail on each of them, but here's a quick summary of what each statement tells us. The balance sheet shows what a company owns, called assets, what it owes, called liabilities, and how much the company's owners have invested in it, called shareholders' equity. The fundamental rule of the balance sheet is that assets must equal liabilities plus shareholders' equity. This is referred to as the balance sheet equation. The income statement shows whether a company made a profit during the accounting period being reported. It shows the revenue a company generated and the expenses it incurred to generate that revenue. If the company is a public company, the income statement often shows earnings per share, which is how much money shareholders would receive on a per-share basis if the company were to distribute all of the net income to its owners. The cash flow statement shows how a company generated and used cash during an accounting period. Cash is very important to a company because even a fundamentally sound company can fail if it runs out of cash. The cash flow statement is needed because the revenue and expense figures on the income statement are prepared using something called accrual accounting, which includes non-cash items. For example, a company might record revenue for goods sold on credit before it receives payment. The statement of shareholders' equity summarizes changes in the shareholders' investment in a company. This is considered the least important of the financial statements and is often not prepared by private companies. Often, there are also footnotes to the financial statements that provide additional information that doesn't fit into the financial statement structure. The footnotes discuss accounting policies and practices and provide additional information on things such as income taxes, pension plans, and the compensation structure of company officers.